Hello. This market is really amazing right now. I don't know if you have been watching all sorts of different companies, especially in the tech sector that has been completely annihilated. They keep going down. And the thing about it is that there are some insane opportunities right now. And I just wanted to make a video and talk about Intel. I may actually even make a video and talk about the Nasdaq as a whole because it has actually given us tremendous opportunities for companies to acquire right now. And Intel right now is probably next to free, or at least close to it. And I'm gonna tell you a few things about its financials. And yeah, you may have reservations because obviously this is semiconductors is obviously a very competitive space. It has lots of expenses as well. There are many other companies, AMD for example, which is like steep competitors and all that. And you may be scared of acquiring a company of that sort, like Intel, for example. But take a look at what is going on with this company right now and its financials. This is absolutely insane. To me, this is a massive bargain right now, and I will explain why. This is 35% down, and if you take a look at the max chart over here, you will kind of see how the company has been doing through the years. This takes a little bit of time because it fetches a lot of data from the previous years. This is still since 1981, basically. You will see how the company has been progressing through the years. And there has been a massive decline, as you can understand, with the overall market. And again, it's down today. And in the past 5 years, again, it has been sort of like staying in a range here, which I like to see if I'm an investor and I'm aiming to buy a company of that sort, really. Because it hasn't actually had any trends right now. It's basically a company that many people don't really like, and this is where I like entering. This is where I like buying my companies, if they are good companies, that is, of course. Now, take a look at this. The P ratio of the company is at 6.25, and the price to free cash flow is a little bit more elevated, but still less than what we would like, less than our threshold, really, of about 20. But 6.25 is absolutely insane here. It's very, very low for a company of that sort, and has been low for a while. Again, higher, but still low. But 6.25 has never been before since I don't know if it has ever happened for Intel, really. So let's take a look at the other metrics here. Outstanding shares that have been going down because the company obviously is buying back shares. That makes a ton of sense, of course. And if we take a look at the revenue growth, has been increasing, but remember, this is a massive company from 63 almost billion, 62 to 80. You cannot grow that fast, but still 25% in the past 5 years, again, for a company of that sort is not bad at all. And you will notice that they haven't had a negative year. Every year they have been increasing their revenue. And the same with the net income. Now, the free cash flow has been going slightly down in terms of the growth, 2017 levels, and we want to examine why this is happening. I'm pretty sure this is about capital expenditures. We have talked about it in the past, so that may be a good thing actually here. Total equity growth, that has been increasing as well. So all the metrics from this company have been increasing. And you will notice that it may have a little bit extra in terms of total liabilities, but we will examine exactly what kind of total liabilities they have and how much in terms of free cash flow. Now, you will see, however, that the debt to equity is actually very low here, so little debt compared to the equity that the company has is always a good thing. Great return on equity, great net income margins here, and a dividend yield of 3.78%, which is probably the only thing that I don't like about this company, because I'm not a big fan of dividends. And it's currently sitting at 60% over here. The free cash flow payout ratio that you will see is about 60%. If we take a look at our dedicated dividends module here, you will see that they have been increasing their dividends. And if you buy the stock right now, you're going to be getting about 4%. 3.88 is the effective dividend yield right now as we are talking. And this looks solid for the company, but I guess, again, I don't like the companies that are paying dividends, because dividends are tax ineffective. They are double taxed. They are taxed in the company level when the company makes net income, and the investor level when you're actually making your gains, your dividends, you are taxed again. But because the company has been doing tremendously well, and because of the numbers I'm seeing, I'm willing to take a little bit of extra cash just by using the dividend yield if I'm purchasing Intel here. But let's take a look at the financial statements. What can we get out of these? Now, 62 billion to 79 billion, again, we talked about this. Revenue cannot grow tremendously for a company of that sort. It's already super large, but it's still growing rather nicely. And if you take a look at the net income, 9.6 to almost 20 is pretty good growth, although it has been achieved in 1 year. And so after that, it has been a little bit steady over here. Now, if we take a look at the balance sheet, you will see that the total equity of the company has been increasing from 70 billion to 95, which is nothing to sneeze at again. And company has been getting a little bit of debt, of course, but overall they have been increasing their assets. Like take a look at the retained earnings here. That's basically the cumulative amount of net income that the company has been generating. So overall, the companies has been increasing their equity, even though they have been buying back shares like crazy. So that's another great thing to see. Still buying shares, still increasing their total equity. I absolutely love this. And if we take a look at the cash flow statement, net income that has been increasing and operating cash flow that has been increasing quite significantly as well. Now they spent a little bit of cash here, probably change in working capital, some extra inventory potentially. You can kind of see it here, pretty much spending some of their cash in 2021. And overall, they had some depreciation, amortization. You could kind of expect this again from a company of this sort. But operating cash flow about 30 billion over here, a little bit less than the years before. For the most part, I'm seeing this is happening because of the change in working capital. So it's basically operations based. Now, the cash from used for investing activities, 25 billion. And you will see here that the company has been purchasing investments by a lot, really, and selling some in the meantime. And again, that's something expected, but paying some dividends as well. And take a look at the repurchase of common stock. They have been repurchasing a lot of common stock here, which I absolutely love to see if I'm a shareholder, of course. And the cash that the company has, 4.8 billion, and the free cash flow from 10 billion to about 10 again. So they haven't been increasing the free cash flow too much. So what happened here? Well, what's the reason behind that? And if we take a look at the cash from investing activities, you can kind of see the story in the capital expenditures. Massive increases in capital expenditures, so minus 11, minus 15, minus 16, a little bit of a slowdown here, but now minus 20 billion, so that's a record capital expenditure year. And investments in property, plant and equipment is the story, which is normal and you would expect it from a company that has a lot of competition and wants to grow. So that's something that doesn't really concern me at all. If this was added back to the free cash flow, you would get about maybe 15 billion or something of that sort here, even more potentially. So this, again, doesn't concern me at all. Now, we will take a look at our stock evaluation tool and see what kind of price it makes sense to pay for this little gem over here. Now, if we examine this company and we say that it doesn't grow from here, 0%, 1 and 2 in terms of the revenue growth, so very, very little growth here for the company in the upcoming years, and a net income margin which is about the same every year, 25, 26 and 27, and a free cash flow margin that's going to be about 80 and 90% overall for the most part, 80, 90 and 100, and an annual return of 13%. What are we getting out of this? Let's hit calculate. Now notice, even if we grow at 0%, so no growth at all for the company, we are still very, very much in the green, and our current price is sitting at 37. Our max price to pay is at 51 with zero growth, that is. And so if the company grows at 2%, which is very, very normal again, and it could be much more than this, then we're sitting at a high of 76 based on the free cash flow that the company generates. And if I want to be a little bit more reserved with our free cash flow margins, which I shouldn't probably, but let's just go 60, 70 and 80 over here, so be even more conservative to what the company generates in free cash flow. Remember, this is this is actually affected substantially because of the increased capital expenditures. This would be much higher here, for example. So let's just take this into consideration as well. Be like, okay, the company will keep on spending some money here in terms of expansion, and even now, even at this point, we are still in the green. And so this is why I consider Intel to be a fantastic company for a long-term hold. Now, in the short term, things could happen. It could go even lower, giving even potentially better prices. But this one is definitely one of the top ones that I would definitely be adding to my portfolio. Thank you for watching the video. I hope you enjoyed. Let me know what you think about Intel. And thank you for watching this video again. Remember to leave a like and subscribe. And if you're interested in this tool, which you can use to make all sorts of projections, assumptions, and pretty much take a look at what the company is doing financially, remember that you can become a Patreon and gain unlimited access. You can find links in the description box below this video. And thanks for watching again. See you soon, guys. Bye-bye.